Have you ever wondered why some crypto tokens explode in value while others crash and disappear, even if they had a flashy launch, big name backers, and great tech? Why some become ecosystems worth billions and others just fade into irrelevance? It all comes down to one word: tokenomics. Not hype, not the roadmap, not even the tech, because tokenomics is the engine, the architecture that determines whether a token flies or fails. And if you're investing in crypto without understanding it, you're basically walking blind into a casino. In today's video, we're going to break down exactly how tokenomics works, not just the definitions, but how to actually analyze it, understand it, and use it to spot long-term winners. We're going to dive deep into both the supply and demand side with examples, strategies, red flags, and what smart investors look for. So, if you stay with me until the end of this video, you'll walk away with a crystal clear understanding of how to evaluate any token and why some tokens thrive while others just bleed out. My name's Karim and welcome back to the Crypto Code by ICN Talks. This will be the only video you need to understand tokenomics. You cannot afford to miss this. Alright, so let's start with the basics. What actually is tokenomics? At its core, tokenomics is short for token economics, and it's the economic model that governs how a token is created, distributed, used, and valued over time. But that's just the technical definition. What tokenomics really is incentive design. It's the structure that tells you how value moves through a crypto ecosystem, who gets rewarded, who takes the risk, and who could end up holding the bag. It's what serious investors look at before they put a single dollar into a project. Because great tokenomics creates aligned incentives and long-term value, but bad tokenomics is just a countdown to the next rug. Just like everything else in an open market, the price of a token is subject to supply and demand. So let's start with the first side of tokenomics, the supply. The supply side is all about how many tokens exist, who holds them, and how fast they're hitting the market. And yes, it really is as simple and as powerful as supply and demand. In crypto, the price of a token is ultimately determined by what the market is willing to pay, based on the circulating supply, the total or max supply, and the perceived value of the network. So when people ask me which project has the best tokenomics in all of crypto, I don't even hesitate. It's Bitcoin, hands down. Let me explain why, and I'll keep it simple. Bitcoin has a fixed supply of 21 million coins. That's it. No more can ever be created. And in a world where governments can print money endlessly, that kind of scarcity is a big deal. It's also completely predictable. Every 4 years, the number of new Bitcoins entering the system gets cut in half, also known as the halving. It's programmed into the code, and everyone knows when it's coming. On top of that, Bitcoin has no pre-mine, no early VC access, no insider allocations. Anyone could mine it from day one. That's what makes it a true fair launch, which is almost unheard of today. And while Bitcoin doesn't run smart contracts like Ethereum, its utility is clear. It's sound money. It's a store of value. It's used as a hedge, and it's becoming a legitimate financial asset on the global stage. The incentives are perfectly aligned. Miners secure the network, holders benefit from scarcity, and no central entity controls the rules. So when you combine scarcity, you combine transparency, decentralization, and demand, it's no wonder Bitcoin has earned the trust of millions. Honestly, it's the only project I'd rate a perfect 10 out of 10 when it comes to tokenomics. And it's one of the main reasons Bitcoin currently holds around 60% of the entire crypto market cap. But of course, not every project can or should copy Bitcoin. Newer blockchains have tried to solve for different problems like energy consumption, speed, and scalability. And that's led to a wide variety of tokenomic models. Some of them great, some of them questionable. By the way, if you're liking what you're hearing, then let us know by smashing that like button and subscribe to the channel. Crypto moves fast, so ping the notification bell as well to make 100% sure you don't miss our next crypto update. Now, there are a few key things you always want to understand about a token supply side. First, who owns what? Token allocations matter. How much is going to the team, the early investors, the community, the treasury, liquidity pools, and so on? Second, when can they sell? That's called the vesting schedule, and it tells you when insiders are allowed to offload their tokens. If early investors can dump everything on day one, that's a massive red flag. And third, is the token inflationary? Is it deflationary? Or does it have a fixed supply? This stuff matters because if there's a constant stream of new tokens hitting the market without a matching rise in demand, what do you think happens to the price? It gets crushed. Now, here's where things get interesting because not all top tokens have a fixed supply like Bitcoin. Let's take Ethereum. It does not have a max cap, so how does it still appreciate in value? Well, Ethereum introduced a burn mechanism. Every time someone transacts on Ethereum, a portion of ETH is burned, permanently removed from circulation. And when network activity is high, ETH actually becomes net deflationary, meaning more ETH is being burned than created. That creates natural supply pressure even without a cap. Now take BNB, Binance's token. They use a portion of their profits to buy and burn BNB every quarter. So over time, the total supply of BNB shrinks. It's an engineered form of deflation designed to reward holders and increase scarcity. So yes, a token can still perform well without a fixed cap, but only if it has strong burn mechanisms or demand-side utility that offsets the inflation. And that brings us to a big mistake retail investors make all the time, focusing on the price of a token instead of the market cap. It's called unit bias, and it tricks people into thinking a cheap token has more upside than an expensive one. You'll see people buying Shiba Inu because it's 0.000001164 dollars, thinking, what if this ever hits $1? But Shiba has 589 trillion tokens in circulation. That would require a $589 trillion market cap, more than the GDP of every country on earth combined. It's just not going to happen. The key is market cap, not the price per token. Always. If you put $1,000 into Shiba Inu, you'd be holding over 85 million tokens. It feels like you're rich, but that same $1,000 in Bitcoin would only get you about 0.015 BTC as of today. One gives you a massive number, the other gives you scarcity, but only one of them has the economics to realistically appreciate in value. Next up, fully diluted valuation, or FDV. This is where things can get sneaky. A project might launch with only 5% of its tokens in circulation, making its market cap look small and attractive. But when you calculate the FDV, which includes all tokens that will eventually be in circulation, it might be 10, 20, or even 50 times higher. And that's a red flag. It means the project hasn't earned its valuation yet, but it's already priced like it has. Always check the FDV. If it's wildly higher than the current market cap, ask yourself, can this project realistically grow into that? Another critical metric, daily trading volume. This tells you how liquid the token is. In other words, how easily you can buy or sell it without moving the price. If a token has a $100 million market cap, but only $200,000 in daily volume, it's illiquid. That's dangerous. You might not be able to exit when you want, or you'll face massive slippage. Slippage is the difference between the price you expect to pay and the price you actually get when placing a trade. In low liquidity markets, even a small buy or sell order can cause the price to spike or crash. So instead of selling it, for example, at $1, you might only get 90 cents or less, especially if there aren't enough buyers on the other side. Strong volume shows real interest, real demand, and a much healthier market. Now let's talk about distribution. Who actually owns the token? If the team and early investors control 60 to 70% of the supply, that's a problem. It means a few wallets can crush the price anytime they want. We want to see a wider distribution, a healthier spread between community, ecosystem funds, liquidity pools, and yes, the team, but in a fair, transparent way. Ideally, you want to see the core team holding less than 20 to 25% of the total supply, with significant allocation going to public participants and community incentives. A well-designed treasury with long-term goals is a good sign. It shows that the project is thinking about sustainability and not just survival. And most importantly, the top 10 wallets should not control 90% of the supply. That's a huge centralization risk. And this is where crypto and traditional equities really differ. Public markets are heavily regulated. Insider holdings are disclosed, audited, and controlled. In crypto, if you're not paying attention, you might be the exit. Let's also talk about how tokens launch. So there's fair launches like Bitcoin or Litecoin, where everyone has equal access from day one. Bitcoin is considered the gold standard of a fair launch because there were no venture capital investors, there were no pre-mined tokens, and no special allocations. Anyone could start mining from day one, including Satoshi, and there were no advantages given to insiders. And then there's VC-backed launches, where only investors get in at a discount before the public. Think Solana, Avalanche, and most modern L1s. Fair launches do feel better, but VC-backed projects often raise more capital and grow faster. The key is balance, transparency, and responsible vesting. VC-backed projects aren't inherently bad, but if early investors control too too much supply with short lockups, that creates massive risk for retail. On the flip side, a fair launch might have better decentralization, but it can struggle with funding and development speed. That's why it's critical to evaluate how a project is launched, who got in early, and what mechanisms are in place to prevent short-term dumping. So, speaking of vesting, this is one of the most overlooked parts of tokenomics. A great project can still get wrecked if insiders dump too early. So what should you look for? What are some red flags and what are some green flags? Red flag number 1. Tokens unlocking right after listing. That's a setup for a dump. Red flag number 2. No public schedule. If you don't know when tokens unlock, that's a problem. And here's a green flag, a 12-month cliff with linear vesting over several years. That shows long-term alignment. One example of a healthy vesting structure, Arbitrum. Tokens are unlocking slowly over 4 years, giving the team time to build without flooding the market. So just remember, cliff vesting means no tokens unlock until a certain date. Linear vesting means tokens unlock gradually over time, and they both help reduce sell pressure. Okay, before we move into the second half of tokenomics, the demand side, let's pull up the screen and walk through the tools you can use to evaluate a project's tokenomics and make more informed decisions. All right, before we get started, I want to show you a platform we built just for you. It's called ICN.live, and it is our flagship ecosystem product, a brand new and fresh Web3 news platform that we have built just for you to find articles in gaming, AI, blockchain, and of course, Bitcoin. So do join the Telegram, sign up today, and you'll get the latest news sent directly to your Telegram. But I wanted to show you the platform overall. So it is a great way where we have all the latest news of what's happening. You can find the latest information on Bitcoin, Ethereum, and everything that's going on. You can also check out the prices, and you can also see any events that are coming up. So we have Token 2049 in Dubai coming up end of April, and there's a lot of things going on, a lot of events that we'll be covering, and make sure you sign up to our Telegram so you get the latest news. So I just wanted to show you quickly what some of the news looks like on here today. So we'll look at, like, for example, this is a big event that comes every year here in Dubai, and if you're not in Dubai, you should definitely come and check it out. It's called the Crypto Polo Cup. It's going to have a lot of the biggest players there, Binance, The Sandbox, Open Wallet as headline sponsors. We're going to be covering the event as well as ICN Web3 Media, and it includes guests like the Sheikh Al-Mualla bin Ahmed Al-Mualla, Firas Al-Sadiq from GAF Capital, a lot of high-profile investors, and a lot of great high-profile attendees as well. I was there last year. It was really a great event. It's hosted by Luna PR, and it's happening on April 27th. So if you're in Dubai, make sure to check it out and see how you can get in. It's actually a really fun event. I really enjoyed networking and meeting amazing people there. So again, ICN.live, we built this just for you guys. Go check it out. Go sign up to the Telegram to make sure that you get the latest news directly, immediately, as well as whenever we upload a new video on Crypto Code, you'll get notified as well. All right, so moving on, what happened to the markets recently? I wanted to just show you guys, I mean, this is obviously after Trump paused the tariffs. Today is April 18th. It's been a hectic, crazy 2 weeks with Trump and his tariff announcements, and then pausing them for 90 days, but still keeping it on China. We just dropped a video about that, so go check it out. It's the video right before this one. Go check it out. It's actually really insightful. But what happened over the past month? Okay, so let's look around. I mean, there's one of the guys that I follow. Whenever he says whenever Fartcoin is up, you know that things are getting a little bit better. So we can see in the past month that Fartcoin is up 129%, and Ohm is down 90%. I thought would be great for this video is we'll go through the tools to help you understand how to assess tokenomics of different projects. But I also thought, since Ohm is, it was a big scandal that's been happening over the past week, and it's down the most out of the past month. We'll talk about its tokenomics. But before that, let's also look at Fartcoin, since it's doing the best this month. So if any retail investor, any new investor looking at the crypto space comes in and sees that Fartcoin is doing so well, let's analyze it together. We'll go through the tokenomics together and assess whether it's something we should look at or not. Okay, full transparency, I've always said I do not invest in memes. I always say I have stayed away from memes my entire career in the space, and so that's just my personal opinion. But if we were coming in new and we saw 90%, the Ohm is down 90% and Fartcoin is up 130%, and we wanted to understand a little bit more about what's happening, this is how we would go about it. Okay, so before we get into all of that, what I wanted to quickly show you are the OGs. So we'll look at I already said that Bitcoin to me, the tokenomics of Bitcoin to me is a 10 out of 10. It's because it is the OG. It is the best tokenomic structure that I've seen. And I think it's not just me. I mean, we all believe that. And that's why it is, it dominates 60%, 63% of the market share today, and why all the institutional investors are also getting in because of its tokenomics. Okay. So what we want to talk about today is why does it have a 10 out of 10 tokenomics and what makes it so special. And then obviously there are some challenges in it. So we'll go into Bitcoin and we'll have a look quickly just to show you things that you should look at. Okay. So you start off by looking at the market cap, which is what we discussed, right? I mean, yes, you look at the price, it's $84,000, makes sense. So how do you get the market cap? You take that price, you take the $84,000, you divide it by the circulating supply, which is 19.85 million right here, the circulating supply. And that's how you get, $84,000 times 19.85 million gets you to the $1.67 trillion market cap. Okay, so that's how you do the calculation for the market cap. Now for the fully diluted market cap, and why you see it as 1.77 trillion versus 1.67 trillion, that's because eventually over time, I think by the year 2140, if I'm not mistaken, Bitcoin supply will eventually reach 21 million, right? So right now it's only at 19.85 million. So there's still some supply that's going to be mined over the next years, but until then, it's the fully diluted valuation is 1.77 trillion. So you can see that here. And for Bitcoin specifically, because already we have much of the circulation out, 94.53% of the circulation out in supply out in circulation. That number between the market cap and the FDV is very close because it's already a lot of it is already out in circulation. All right, so this is how you would look at this. Again, 21 million BTC is very little. Not everyone on Earth could get one Bitcoin, and that's why it's so scarce. It's written in code. But the downsides are it is a proof of work consensus. It takes a lot of energy, a lot of computational effort, and a lot of power to kind of do these calculations and keep the network running. So that's the downside, that it's become very, very computational heavy energy. It takes a lot of energy, and what's really interesting as well about this in the tech is that it's forced chip makers to figure out how to become more efficient. It's forced computers and chips also to figure out how to use less power or cooling systems as well to keep everything cool while it does all this computational. So there was a positive reaction to kind of figuring out how to solve and make sure that we can continue to mine Bitcoin even though it's getting more energy intensive. So that's what I find really cool. All right, so that's Bitcoin. Now number 2, Ethereum, right? We said that in an ideal world, we just want to look at tokens that have a fixed supply or a deflationary supply as well is also good, because if you can control the supply in theory in an open market, then that creates more demand, right? However, Ethereum does not really follow these rules. So if we look at Ethereum and we look at the same metrics here, so we'll look at the price, $1,587 as of today, and then we look at the current circulating supplies, 120.7 million ETH currently. So if you multiply 1587.5 times 120.7 million, you got a market cap of $191 billion. The FDV is exactly the same, and the reason why is because the max supply has this infinity icon right here. And the reason why it has an infinity icon is because it is inflationary. The Ethereum Foundation can mint more Ethereum to reward the network, because they've switched from a proof of work, which was very similar to Bitcoin, to a proof of stake. And in proof of stake, the way they incentivize to keep demand high for Ethereum is for the network nodes to stake a lot of Ethereum onto the network to ensure the ensure the security of the systems and make sure that no one's really cheating and double counting on different transactions. So that's how they've decided to do it. And then a lot of other layer ones have also followed suit with this proof of stake model. And in that case, usually there is an infinite max supply. And then if it can also be controlled. And as we discussed earlier with Ethereum, for example, they do burn some of the profits along the way from transactions to create a net deflationary situation, which then kind of manages, so the more you use Ethereum, the more it burns the tokens, and therefore creating downward pressure on the supply and upward pressure on demand. So that's very interesting. Again, tokenomics is a mix of art and science and math, and it's super fascinating. But unfortunately, a lot of people have taken advantage of this, and because not everyone knows how to read this and look into it, you've seen projects come and try to use this against use it against other people's advantages. disadvantages, sorry, and unfortunately scam them, and rug pull is the term that we tend to hear a lot of the time. All right, so now we looked at the crypto bubbles. We saw that Fartcoin has been doing the best out of the past month. So now let's say I'm curious, I want to understand what's going on with Fartcoin. So let's open it up and see how we would assess the tokenomics of Fartcoin. Okay, so we're gonna go through it together, and then I want to rate it and just give you my honest opinion on what I think the tokenomics would rate out of a 10 for Fartcoin based on everything that we're discussing throughout this video. So we'll look at the price. It's 75 cents right now, 0.7528. Total max supply is 1 billion. Circulating supply is 999.99 million. So that's actually good because pretty much everything's out in the public. No one can dump anymore and that. But we need to be careful because we need to see who are holding. So what I would do in a situation like this, again, I don't invest in meme coins. I would never invest in Fartcoin. I'm just not curious about it. But if you wanted to understand what they do, so we'll look at the distribution. So I did some research, obviously, and the distribution is 20 million tokens allocated to the Truth Terminal AI agent. So this was done when there was a lot of hype around the AI agents. Remaining tokens distributed to early participants through community meme submissions and liquidity pool incentives like platforms on platforms like Radium, which is the decentralized exchange on Solana. So this is all built on Solana. And if you go here to the explorers and you click on it, it'll take you to essentially the dashboard of what, everything that you can see about this specific token, current supply, market cap, holders. So here you'll see right here 143,644 holders, which is quite high. And then over here you'll just start seeing transfers and transactions that are live right now. You'll be able to see who they are if they're named, but most of the times they're going to be anonymous. And so that's what you see here. Essentially, a wallet address is like an IBAN, but the difference is you just don't know who that IBAN is for, but you can publicly see what that IBAN is doing, if that makes any sense. Okay, so here you can see transfers, transactions, and then this is another thing that's really interesting. If you go to holders, this will help you understand who or how much of the token is being held at the top by a lot of people. And usually if you see it kind of like centralized towards the top, that's usually a red flag. Let me just refresh this here. Okay, so meanwhile, what is the utility of Fartcoin? So users can earn tokens by submitting fart jokes or memes, fostering community participation. I don't know how people come up with this. I know where he came up with this idea. I can imagine where this person came up with this idea. All right, so we look at the holders again, and now that it's loading, I'll continue on what the utilities are in a bit. So what you can see here is if you do it by if you want to see who has the most, it shows you that Kraken, which is a centralized exchange, has 23 million Fartcoin, which is 2.3%. You see Gate.io, you see BitGet. These are all centralized exchanges. Kraken, Radium, Mexi, these are all Wintermute, all of them. But then you start to see these addresses, which I don't know who they are, and they probably, I'm sure if you go online, you'd probably be able to figure out who it is. But these guys own 1% of the token supply, so $7.5 million worth. If they were to dump their allocation, there would be some price. It would affect price. I don't know by how much, because in the grand scheme of things, it's a $750 million project, right? But if they all dump their tokens at the same time, let's say the top 10 who own 1%, that would definitely, affect the price. And what could happen then is it triggers a downward spiral because other people will be like, oh my God, it's going down. They start panic selling, and then everyone gets out. And it's like if there's a run on the ATM machines of a traditional bank, let's say there's a crisis in the country, people run to the ATMs, take out all their cash, it would be a bank run and it would just be terrible for the economy. The same thing here. If a lot of the big holders start selling, you see a red candle, more people start selling, and shit hits the fan. Excuse my French, but we'll talk about exactly what happened with another project that was the shining star, and we'll talk about it and I'll explain exactly what that is. Okay, so going back to the utility of Fartcoin, so it's literally a meme. People share different things and it becomes a community thing. So I don't think that's really a utility in my opinion. That's just again, it's like how much demand is that ever going to be, and it's just like, for me, it's like a fad. It's not going to last long. Okay, so based on what I just saw, this is for me, a terrible tokenomic structure. I would never invest in this. I would give it a 6.5 out of 10. It represents a creative approach to tokenomics by intertwining humor with user incentives. While its mechanisms are engaging, the token's long-term viability will depend on sustained community interest and effective allocation of resources. Okay? Again, not a fan. Let's move on. Now, we looked at the last month. What did we see? We saw Mantra. We saw Ohm go down 90%. Everyone's talking about this. Why? Because they were a $5 billion market cap project. They were really pushing RWA. They're based in Dubai. They've raised money from very credible investors. So they really had a huge momentum, huge hype. They had mind share in a very exciting space, RWA, real world assets, right? So how can this happen? I mean, the tokenomics are obvious. I mean, they're open, it's transparent, everyone can see. So how can this happen? Okay, so this is Mantra's page, right? So if we look at the 1 month, I mean, unless you've been living under a rock and really not been on X or even LinkedIn for that matter, you've seen this, right? So they were trading literally on the 14th, like 4 days ago at $6.2, right? At a valuation above, I think it was, let's look at market cap here. You can see that too. At a market cap of $6 billion. $6 billion. Okay. One day. Listen, look at the 5 a.m. all the way until right here. They were $6 billion company. And then 1 hour later, they were $600 million company, which is still a huge number, by the way, but still 90% wiped out. That's insane. And that calls for investigations, not just from the authorities, but like X. And I'm going to show you this. I mean, everyone's on top of this because whenever you see a chart like this, a lot of questions start to be asked. Obviously, the team has been very responsive. They've been out publicly trying to figure out what happened here because we want to understand what we can learn from. There's a lot of things to learn from when a situation like this happens, right? We should never point fingers. We don't know the full story, but what can we learn from this to make sure it doesn't happen again? And what can we learn from this to recoup, hopefully, the investors who lost a lot of monies, their money, their investment back again. So let's look at this, right? We look at Mantra. So it's now trading at 64 cents. The market cap then would be 64 cents times the circulating supply of 962 million, right? And that's how you get that market cap. Now the FDV, the fully diluted value, as we mentioned, is $1.1 billion here, right? Why? Because the total supply is 1.8 billion. That's going to be out, but there's no max supply because this is an inflationary token. They can print if they wanted to, but from what I see here, they basically have an incentive just to have 1.8 billion for the time being. Okay, so this is what I would look at just to understand what's going on. That would be my first impression, and then something that's really interesting now with CoinMarketCap and others, they start to show you the token unlocks. Since this project is not a fair launch project like Bitcoin, like Litecoin, where everything was mined from the beginning and everyone had a chance to mine the same amount. This one was kind of pre-mined. It was pre-mined. They sold, they raised money from investors. And here, if you go into token unlocks, you start to understand what that is. All right. So I did some research just to understand the tokenomics, and I'm going to be honest with you. It's a lot. It's a lot, and it's like when it gets a little bit confusing like that, when I just can't, when 1 + 1 doesn't really equal 2, or like there's just I need to wrap my head. I need to have I feel like I need a master's degree or a PhD in tokenomics just to understand the way that they've structured this. And the reason why I'm saying that is because they had launched it initially on Ethereum, and then they did a relaunch, and then they took basically, okay, the total supply of Ohm tokens was increased from 888,888,888. Clearly this person lived in China, to 1.7 billion to accommodate the needs of the Mantra chain's POS model. Inflation. Mantra adopted an inflationary model with a fixed annual inflation rate of 3%. That's not bad because it's still less than what the inflation is currently, from fiat. Designed to provide sustainable staking rewards and ensure network security. All right. So the distribution. So 888,888,888 Ohm. I'm just going to call it, 888 million. 50% reserved for existing ERC20 Ohm holders to be migrated to the Mantra chain. All right, so that's what it is. They had launched it on Ethereum, then they decided to create their own layer 1 chain, okay? So they had launched this token. A lot of investors got on board. Then they decided they're going to do their own layer 1 chain, but they're like, hey, my existing investors want to get a piece of this new thing as well. So how do I shift them from that to this? And I think this is when things start to get it's not as clear, it's not as transparent, because now you're kind of lost with like old investors and new investors. And I mean, for me, it was, as I did the research, it was quite something to understand. All right. So the upgrade incentive was 311 million Ohm, or 17.5%, allocated to incentivize the legacy Ohm holders to migrate their tokens. The core contributors, 300 million tokens, around 17%, designated for team members and core contributors with a 30-month cliff. Very nice. That's better than the 12-month we mentioned before. And they're also 17% for the team allocation is not bad at all. It's fine. Over the next 30 months, which is great. Staking rewards, 215 million, 12% allocated for staking, and so on. So here what you can see is just a lot. So mainnet pre-seed, they did 190 million. Genesis airdrop, they did 50 million. And ecosystem, they left 37 million Ohm. Okay, so what is the utility? And let's just wait one quickly. Sorry. Let's look at the token unlocks. Okay, so here what you can see is basically everything that I mentioned is basically here. So 16.8% as a team, Mantra Chain Association, and so on, right? And what's interesting now with this chart, it shows you and gives you an expectations of how much of the Ohm token is going to be released into the open market over time. It shows you today what's happening. We're right here. So we're halfway through the vesting schedule, as I would say. So that should keep you, you should be mindful and aware of what's coming. And the more tokens that come onto the market, it's just natural supply and demand. Usually, in most cases, the price will go down as more supply hits the market, right? This is the opposite of, and there's also 3% inflationary, which is that. Okay, so what's the utility? It is an RWA chain. They're building amazing partnerships with very reputable real estate developers like Damak, and they're in Dubai. They have a VAR license. Everything is fantastic, and I'm very excited to see how this plays out. I think the chain is fantastic. I think the team is doing a great job handling this situation. I just want to understand, how can we avoid like a 90% drop in 1 hour? I would just like to understand how that happens so that we can avoid it in the future, because it doesn't, it's a challenge. So the utility for this one, or the demand side of things, is users can stake Ohm to secure the network and earn rewards. Okay, that's like Ethereum. Governance, so Ohm holders can participate in governance decisions, influencing protocol upgrades and ecosystem development. I have an issue with governance being a utility, because obviously, if you're an early investor or a core member of the team, you have more tokens than everyone else, so you could just kind of vote the way you want, which is fine. I mean, that's usually how public companies work, right? I mean, Tesla, I think the final say goes to Elon, if I'm not mistaken, even though he only has 19% of the shares, which is the most. All right, so transaction fees, access to services. Assessing this was going to be tough. I mean, just because it's so confusing and there was like a legacy versus the new and all that for me, and it was just not straightforward. I wouldn't be able to explain this to my mother. How about that? So maybe that's the best way to say this. I also gave this a 6.5 out of 10. I feel like because it was a little bit difficult for me to understand, and I can't explain it that well, then it's just something that I found difficult. And I don't think, again, tokenomics is an experiment. Everyone's trying different things, and unfortunately in this case something happened. I mean, someone had a lot of tokens and they sold it. I mean, I don't know what happened exactly. They're saying someone had collateral and they got liquidated, but that's terrible, right? That theory should not happen. All right, so let's look at, since this is a huge scandal right now and it is involved with tokenomics, I just went on X and started to look at what people are saying. Okay, this is what people are saying. None of this, again, I don't think there was any wrongdoing. I don't think there was any malicious behavior. We just want to understand what happened so that we can figure out how to make sure it doesn't happen again. I work with a lot of startups as well, working on different tokenomics, and again, it's a very challenging thing, because it's not easy to come up with. All right, so all hype, no fundamentals and poor tokenomics. The $5 billion collapse of Mantra, read below. So if you click on this link, it's going to take you to this, and then everyone's talking about this chart. When you see a red candle like that, I mean, it's truly unbelievable. There's already a couple of interviews with the founder. You can go check those out. So they literally doubled the supply, as Ed said. And out of that new supply, they kept a large chunk of that as well for core contributors, seed funding, and ecosystem grants. It didn't help that hype around partnerships in Dubai created the illusion of traction, all right? So obviously people who lost money are going to be very skeptical and be very negative about what happened. All of this is out there. You can read it on your own. But I just wanted to highlight how important tokenomics is, because if it's not done right, you get a candle like that. You get everyone pointing fingers, trying to figure it out. You get investigations by the financial authorities. It can really be a disaster for you and your project. It can be really, a lot of people can lose money, and then you don't want to be that person who was sitting on top of the world and now you have to answer all these questions. So looking at tokenomics is super important, all right? So an autopsy of the Mantra chain collapse, and autopsy on the post-mortem. There's a lot of amazing stuff on X where you can go into it and read about what's going on. But the most important thing that I want to say, the crash affected the ERC-20 Ohm, launched in 2020. In 2024, a second Ohm token was launched on Mantra chain, another 888 million. So total supply is this. I think that's where things got really messy, is when they took their ERC-20 tokens and then had their new ones, merged it, and then probably lost control over who had what. And then once you get to a billion-dollar company, I think that's when you start getting a lot of haters who really want to see you come down, unfortunately, right? Everyone's excited to see you rise to the top, but as soon as you're at the top, they want to try to bring you down. And unfortunately, this is what happened. Okay. I think JB and the team at Mantra have done a great job in kind of being forthcoming with the community. This is another guy, JB Jeet Burner. I invested $3.5 million into your RWA token. That investment now is worth $200,000, a drop of over 90%. It's real money, guys. This is what I want to show you. Like these are real investors who are losing real money because of tokenomics. Simple as that. And there are real investors making a lot of money with great tokenomics, like with Bitcoin. Okay, it's as simple as that. So always pay attention. You need to pay attention. Everything looked great on paper. This investor did all the research, did all the due diligence, put $3.5 million again. And now it's worth $200,000. This is real money that happens. So what are they going to do next? This is, let's look at this. I'll just quickly go into it. Okay, so new Mancha Chain releases 4-step plan going forward. And this is what we talk about. By controlling supply, you get to increase the demand, okay? So number 1, Ohm token support plan for buyback and to burn the token. JP, the founder, and the team's allocation are going to be burned to show that they were not part of this, and then, to just give back faith to the community. And then they're going to have a transparency dashboard. So they're going to burn tokens. They're going to burn their own tokens to reduce the supply and therefore hopefully bring up the price and demand. So that's what I wanted to show you guys today. I hope this helps to show you a real case understanding of how tokenomics can really burn the trust of a project and can also get people excited to invest in it. Now, let's move into the other half of tokenomics, the demand. Even the best supply structure won't matter if no one wants the token. So the real question is, what's the utility? What do people need the token for? Why would someone go out of their way to buy it? The strongest tokens have clear, persistent demand drivers. Take Ethereum again. You have to use ETH to transact on Ethereum. That's built-in demand. Or BNB. If you're using Binance, holding BNB gets you lower fees, access to launchpads, and other perks. That's real utility, not just hype. And in the AI space, some Web3 projects require users to stake tokens to access advanced AI models or pay for compute resources, making the token essential for participation. Think of it like buying credits to use a decentralized version of ChatGPT, but instead of a subscription, you're using the project's native token. And in Web3 gaming, the strongest demand comes when tokens are used to unlock gameplay, upgrade assets, or access competitive features, not just as empty rewards. Games that require players to stake or spend tokens for access to exclusive tournaments, NFT upgrades, or cosmetic customization can create lasting demand beyond speculation. And in the RWA space, tokens are often used as proof of ownership or as a gateway to earn yield on tokenized real estate, commodities, or treasury bills. If you want access to those income streams, you need to hold and sometimes stake that token. Some RWA projects even require users to lock tokens in exchange for governance rights or early access to high yield opportunities, creating sticky, utility-driven demand that aligns with investor incentives. These are all powerful use cases because the demand is functional, not just emotional. People aren't buying the token because they hope it pumps. They're buying it because they need it to do something valuable. The strongest tokens in this space don't rely on hype. They rely on utility, they rely on access and alignment between holders and the ecosystem. And then there's fake demand, reward-based tokens that pay you to use them but don't offer actual value. We've seen this in play-to-earn games. People only stuck around for the token rewards, and as soon as the price dropped, they vanished because the games weren't fun. The product had no stickiness. Utility has to be real. Otherwise, the token is just a temporary coupon or incentive. It's not an investment. If you made it this far, congrats. You now understand tokenomics better than 95% of the market. You understand how supply works, why inflation and vesting schedules matter, what to look for in token distribution and fully diluted valuations, and how to analyze demand and utility. Tokenomics isn't just some niche detail. It's the heartbeat of every crypto project. It's how value flows and whether that value sticks around. So before you ever buy another token, ask yourself, who owns the supply? When do more tokens unlock? And why would someone need this token tomorrow, next month, or next year? If you can answer those, you're not just gambling, you're investing. Let me know in the comments, what token do you think has the strongest tokenomics in 2025? And which ones are fooling people with smoke and mirrors? If you made it this far in the video, thank you. See you next week.